Most people think the safest place for their money is the bank. You work hard, save consistently, and feel good watching that number in your account slowly grow. It feels responsible, right? Secure, safe. But what if I told you that keeping too much money sitting in your bank account might actually be one of the biggest financial mistakes you could ever make? I've seen this mistake over and over again. People saving tens of thousands, sometimes even more, and feeling proud about it, not realizing that their money is quietly losing value every single day. The truth is, banks don't make your money grow, they make your money sleep. It sits there, motionless, while inflation silently eats away at its real worth. You feel like you're being careful, but in reality, you're slowly losing purchasing power. Let's break it down in a way that makes sense. Imagine you worked your tail off all year to save $10,000. You put it safely in your bank account. Fast forward 12 months, that money hasn't moved, it's still $10,000. But when you go to buy groceries, pay rent, or book a vacation, everything costs more. That $10,000 can now buy less than it could a year ago. That's inflation. Your money didn't grow, it got weaker. Meanwhile, the bank takes your money, lends it out to other people, invests it, and makes a profit. You're earning maybe 0.5% interest, if you're lucky, while they're making 6%, 8%, sometimes more with your money. You did the hard work, but they got the reward. That's why I call cash in the bank the laziest employee you'll ever hire. You work every day, you show up, you put in effort. But your money, it's just lying there doing absolutely nothing for you. Now, before you start thinking, but wait, I need my savings. Yes, you do. But here's the thing. Most people have far more sitting in the bank than they'll ever need for emergencies. And that's where it becomes a trap. You've heard about the emergency fund rule, 3 to 6 months of essential expenses saved up in a separate account. That's smart. That's your safety net. But keeping 40,000, 50,000, or even 100,000 sitting idle just because it feels safe, that's fear disguised as financial responsibility. When I worked in finance, I met so many people like that. People with huge amounts sitting untouched in their accounts. They'd say, it's my emergency fund. But when we broke down their actual expenses, they didn't need even half that amount. The rest was just money sitting there, quietly losing value every single day. And here's the part no one talks about. When you have too much sitting in your account, it starts to mess with your psychology. You check your balance and think, oh, I've got plenty. So you spend more freely. You go out more often, upgrade your phone, book that weekend getaway, because it feels like you can afford it. But that money wasn't meant for spending. It was meant for something bigger, your future, your freedom. That's exactly why I always say, automate your money before your emotions get to it. The moment your income hits your account, you should already have a system in place that directs it where it needs to go. A portion to your emergency fund, a portion to investments, a portion to bills, and a small percentage to enjoy. Because if you leave it all in one place, it becomes too easy to waste without realizing it. Now, there's another reason why this is so important: insurance protection. Most people don't realize that banks only guarantee your money up to a certain limit. In the UK, that's $85,000 per bank. In the US, it's $250,000. If your bank ever collapses, and yes, it happens more often than you think, anything above that limit could disappear overnight. Imagine saving your entire life, keeping it safe in one account, only to find out that part of it isn't protected. That's not security, that's risk. So what's the smarter play? Simple. Keep only what you need for your emergency fund, 3 to 6 months of expenses in a high-interest savings account. That's your buffer. Everything beyond that should be working for you. Whether it's in diversified index funds, government bonds, or other low-risk investments, your goal should be to make your money grow while you sleep. Because when your money works as hard as you do, that's when real wealth begins to build. And let me tell you something that'll change how you see your finances forever. Every dollar sitting idle is a missed opportunity. It's not just about numbers on a screen, it's about what those numbers could become. That same $10,000 you let sit still could have doubled in 10 years if you just put it somewhere that grows. You don't have to be a Wall Street genius. You just have to stop being passive, because here's the truth. Safety doesn't come from hoarding cash. It comes from understanding how money works. The people who build wealth aren't necessarily the ones who earn the most. They're the ones who make their money move. They give it direction, purpose, and power. So next time you feel proud seeing a big number in your account, remember this: that money isn't safe. It's asleep. And the longer it sleeps, the more it loses. Wake it up, put it to work. Because the biggest mistake isn't losing money, it's letting fear stop you from growing it. Here's the truth that no one really tells you: there is a right amount to keep in your bank account. And anything more than that, it's not security, it's slow decay. See, most people think the more cash they have sitting in their account, the safer they are. But that's not safety, that's comfort. And comfort is one of the most expensive habits when it comes to money. Because every dollar that sits in your bank is quietly losing its power. Inflation doesn't make noise. It doesn't send you a notification. But it's there every day, taking little bites out of your wealth. So how much should you actually keep? Let's make this real. Forget all the complicated financial talk for a moment. Ask yourself one simple question. If I lost every source of income tomorrow, how many months could I live on my savings? That number, your bare minimum living expenses, is the foundation of your emergency fund. Think rent or mortgage, groceries, utilities, essential bills, basic transportation, and any debt repayments. Nothing extra, no subscriptions, no vacations, no takeout dinners. Just survival mode. Once you've got that monthly number, multiply it by 3. That's your baseline emergency fund. If you're someone who prefers more cushion, make it 6 months. And if you're self-employed or your job income fluctuates, aim for 9 months. That's it. That's your safety net. Anything beyond that is what I call lazy cash. Money that could be doing more for you, but isn't. When I worked in finance, I saw people with $40,000 or $60,000 just sitting in a checking account, doing absolutely nothing. They'd tell me it's for emergencies. But when we sat down and calculated their real monthly expenses, they only needed about $15,000 for 6 months. The rest, that was fear money. Money kept there just to feel safe. But here's the thing about fear money. It's comfort disguised as progress. You tell yourself you're being smart, responsible, prepared. But that fear is actually holding your wealth hostage. It's stopping you from letting your money grow. Now, let's be clear. We're not saying to dump all your savings into risky investments overnight. That's not what smart money looks like either. Smart money is strategic. It understands that every dollar has a job. And the job of your emergency fund is to protect you. The job of your long-term money? To grow. So here's what I tell people. Separate your money into clear categories. Your emergency fund belongs in a high-yield savings account, something that earns at least 4% interest and lets you access it when you need it. That's your safety zone. Then your short-term goals, things like a house deposit, wedding fund, or car purchase, those go into another high-interest account or even a short-term bond fund. You'll need that money soon, so it shouldn't be at risk. But everything beyond that, your long-term goals, your future, your freedom, that's what needs to be invested. Because if your money isn't growing, it's shrinking. It's that simple. Think of it like this. Your money should have movement. If it's not flowing, it's fading. Money left sitting in one place too long loses its energy, its momentum, its purpose. But when it's invested wisely, whether it's in index funds, ETFs, or other assets, it compounds. It grows on top of itself. That's where wealth starts to multiply. Let's take a quick example. Let's say you have $20,000. You keep half, $10,000, as your emergency fund in a high-interest savings account. The other $10,000 you invest in a simple, diversified index fund that returns 8% annually. In 10 years, that $10,000 turns into over $21,500. You didn't lift a finger for that growth. That's the power of letting your money move. Now, you might be thinking, but what if the market crashes? That's a fair question. And it's one of the biggest reasons people keep too much in the bank, the fear of losing money. But here's the thing. The market has crashed dozens of times over the past century, and it's recovered every single time. History shows that those who stay invested always come out ahead. The people who panic, who pull out, who play it too safe, they're the ones who lose. Playing it safe feels good in the short term, but it costs you in the long run. Every day your money sits idle, it loses a little bit of its strength. It's like a muscle that's not being used. It weakens. And here's something powerful to remember. Banks are not your wealth builders. They're your temporary shelters. You don't live in a shelter forever. You rest, then move forward. Your savings account should be the same. It's there to protect you for a moment, not to hold you forever. So if you've been sitting on a large balance in your account, feeling proud, thinking you're doing the right thing, it's time to see it differently. You're not protecting your money, you're paralyzing it. And money that doesn't move can't multiply. Your job is not just to earn money, it's to direct it. Tell every dollar where to go, what to do, and how to grow. Because the people who build wealth don't let fear or habit decide for them. They build a system that makes their money unstoppable. There's another hidden problem with keeping too much money in your bank. It makes you spend more. It sounds strange, but it's true. When you open your banking app and see a big balance sitting there, your brain instantly relaxes. You feel secure, successful, even a little generous. So when you see those shoes you like, or that weekend getaway pops up online, you think, I can afford that. And before you know it, that extra money starts disappearing. What's really happening is psychological. When your money isn't organized or separated by purpose, your brain assumes all of it is spending money. You forget that a big chunk of it might actually be your emergency fund, your rent, or money meant for investments. But because it's all in one pile, it feels like a green light to spend. I experienced this myself once. A few months ago, I switched bank accounts and didn't set up my automatic transfers yet. So all my income started landing in one account. And in just a few weeks, I noticed something strange. I was spending more without realizing it. Little things, small upgrades, impulse buys. Because when you see money, you feel free to use it. That's why the key to financial control isn't just about saving or earning more. It's about hiding your money from yourself. Automate everything. The moment your paycheck arrives, split it automatically. Investments, savings, bills, and then spending. Out of sight, out of mind. When you make this switch, you'll be shocked at how calm and confident you feel, because suddenly every dollar has a job. You'll stop overspending, not because you're trying harder, but because you've built a system that makes smart money habits automatic. And that's where true control begins, not in having a bigger bank balance, but in having a smarter one. Now, here's the part most people never think about. Your money in the bank isn't as safe as you believe. You see, banks only insure your money up to a certain limit. In the US, that's $250,000 per person per bank. In the UK, it's $85,000. Anything above that, you're trusting the system to never fail. And while that sounds fine, we've all seen headlines where banks collapse overnight and people suddenly realize they've got more cash at risk than they thought. But even if your bank never fails, there's a quieter danger: inflation. Every year, it eats away at the value of your cash, silently, consistently. Your money is losing its power, one grocery trip at a time. So while you think you're playing it safe, you're actually watching your wealth erode in slow motion. So what's the fix? It's not about pulling all your money out, it's about putting it to work. Keep only what you truly need for emergencies and short-term goals in cash. That's your safety net. Everything else, move it into assets that grow, index funds, ETFs, or any well-diversified investment that lets your money breathe and expand over time. And most importantly, don't let fear keep you frozen. Because the truth is, your money can't protect you if it's not moving. Wealth isn't built by holding, it's built by flowing. So the next time you log into your bank account and see that comforting number staring back at you, ask yourself, is this money safe or just standing still? Because in today's world, the biggest financial mistake isn't losing money, it's letting it sleep.